Hello everyone and welcome back. In this video, I am going to discuss ISA 510, which is about opening balances on initial audit engagements. Imagine you are appointed as an auditor for a company for the first time. Naturally, a key question arises: how can you rely on balances that were audited by someone else or maybe not audited at all? This is exactly where ISA 510 becomes important. First of all, let me discuss about what we mean by an initial audit engagement. An initial audit engagement occurs when the financial statements are audited for the first time or the auditor has changed. Therefore, the auditor does not have prior experience with the entity's financial information. Moving forward, we need to define opening balances. Opening balances are the closing balances of the previous period which become the starting balances for the current period. For example, last year's closing inventory becomes this year's opening inventory. Similarly, last year's closing receivables becomes this year's opening receivables. At this point, you might wonder why our opening balance is so crucial. The reason is quite straightforward. If opening balances are incorrect, they will affect current period results, distort financial position, lead to incorrect audit conclusions. Therefore, the auditor must ensure that the opening balances are free from material misstatement. Now, understand the auditor's objectives. The auditor must obtain sufficient appropriate audit evidence that opening balances do not contain material misstatements, closing balances of prior period have been correctly brought forward, and appropriate accounting policies are consistently applied. So, how does the auditor achieve these objectives? First, if there was a previous auditor, the current auditor may review prior audit working papers and evaluate the previous auditor's conclusions. However, this depends on access and permission. Next, the auditor should examine prior year financial statements and auditor's report. For example, was the previous audit opinion modified? Were there any issues affecting opening balances? In addition, the auditor may perform audit procedures such as verifying opening balances directly, testing transactions affecting opening balances, like checking subsequent collections for receivables, reviewing purchase records for inventory. Furthermore, the auditor must ensure that accounting policies are consistently applied or changes are properly accounted for and disclosed. This is important because inconsistency can lead to the misleading financial statements. Inventory is a particularly important area under ISA 510. If the auditor was not present at last year's inventory count, then the auditor must perform alternative procedures. For example, review past records and perform test counts and also reconcile movements. However, if sufficient evidence cannot be obtained, this may result in a qualified opinion. What if the previous auditor issued a modified opinion? In such a case, the current auditor must assess whether the issue still affects current financial statements. If it does, then the auditor may need to modify the current audit opinion as well. At this stage, it is important to understand the consequences if the auditor is unable to obtain sufficient appropriate audit evidence regarding opening balances. This results in a scope limitation. Therefore, the auditor may issue a qualified opinion or a disclaimer of opinion. Now, stepping back, let us connect everything. ISA 510 is fundamentally about trusting the starting point of the audit, because if the beginning is wrong, everything that follows will also be unreliable. So, to summarize, first, ISA 510 applies to initial audit engagements. Next, the auditor must verify opening balances. Furthermore, procedures include reviewing prior audits and performing substantive testing. In addition, consistency of accounting policies must be ensured. Finally, if sufficient evidence is not obtained, the auditor may need to modify the audit opinion. In conclusion, ISA 510 ensures that the auditor does not blindly rely on past data. Instead, the auditor must critically evaluate the foundation of the financial statements. And that's all for today. Allah Hafiz.